global uncertainty, U.S. exceptionalism coming under question, and really this shift in priorities towards national interests. What were some of the discussion points?
Yeah, so clearly we have a new potential disruptor, and we would argue these various policy pivots all kind of come back to the interconnected issue of global trade imbalances. What the administration would argue is that efficient market mechanisms should effectively balance trade over time. So an example of that is if you have a country that has a competitive advantage in some product or service, they'll export. They have an initial trade surplus. But as a result of that, they also are getting higher domestic incomes from all of those profits coming back in the country, and they consume more. And as they consume more, they import more things. You probably also have a currency adjustment and appreciation that's happening, and over time that helps rebalance trade. So you effectively are exporting to import. But if you look at the last 40 years of trade within the global economy, what you see is that mechanism clearly has not happened. So we have countries that have effectively run serial trade surpluses, China, Japan, maybe before the pandemic, also places like Germany, Korea, Singapore, against other countries in the global economy that run serial trade deficits. That's the United States. But also you have countries like the UK and France that do as well. So, there's a key question around why is that happening? Why are we not getting that rebalancing? And the administration would argue it's because of policies, regulatory, other sort of structural policies within these trade surplus countries that effectively depress consumption. They require their household sector to subsidize manufacturing. And so the result of that has been places that don't do that, like the United States, they can't compete. And we've had a hollowing out of the middle class. We've had a reduction in manufacturing share in the United States because we can't compete with this. As a result of how the government social safety net is set up, that's resulted in automatic stabilizer type of programs that have increased the U.S. federal fiscal deficit. So things like Medicare, food assistance programs, U.S. disability programs, all have had increased pickup as a result of what economists call this a China shock. So as you can see, as I'm talking, these are structural issues that require structural adjustments that will be difficult. And I think that, just puts in perspective the broader discussion that's happening in Washington around really cutting federal government spending and fiscal deficits. So all this is to say is that the Fed has some tricky decisions that they're going to make. We think it really will boil down to, are recession risks rising faster than inflation risks? And on this point, I would say that it has been recently a very uncomfortable increase in inflation expectations across the various consumer surveys and business surveys more recently. And this could eventually constrain the Fed. It's obviously going in the direction they don't want it to go. We think what it means is the more preemptive cuts that the Fed did in 2018, 2019, for example, against potential weakness, they could be more constrained in that. But nevertheless, if they're seeing the unemployment rate increase, we think they're cutting aggressively as those recession risks are increasing. But the U.S. is not the only place that needs to make these adjustments. Elsewhere, like China, other places also need to make those adjustments. The U.S. is trying to force that through higher tariffs. That's creating some disruption. And, it's really yet to be seen how much additional price level adjustment, how much additional market volatility the U.S. voter base is willing to tolerate to get through this period. So I think all of this is to say is that these structural adjustments, they have important constraints, and that's just creating a lot of near-term uncertainty.